Christopher Peel is with us, the Chief Investment Officer of Tavistock Investments. Christopher, last time I think we had you on back in April, you said the Fed's pivot and Donald Trump keeping pressure on Jay Powell will mean that we will see new all-time highs. Congratulations, we got there. Now what next? What should our investing audience be doing, given that overnight Jay Powell just tempered expectations that rates are coming down?
I think the Fed has clearly been pressured by the White House. It's been going on for a number of months, and I don't see it letting up. And also, it's coinciding with softening some of the data in the U.S. Some of the more recent PMI numbers, are showing that there is a slowdown consistent with what we're seeing elsewhere in the world. I think you're seeing a shift or drift back to what we've seen over the last 2 to 5 years, where interest rates will be, being lowered, whether it be in China, Europe, or in the U.S. Potentially a return to QE, which means we're the Goldilocks scenario where bonds can continue to rally, equities continue to rally, will re-engage. So I think in terms of where equities are globally, I think the lower interest rates trend, the cheaper equities become, and I think you're going to continue to make new highs in whether it be the U.S. market or elsewhere. It's probably also very bullish for emerging markets because it looks like the dollar, the bull run in the dollar is starting to fade out, which will be very positive for EM debt and equity.
That is the most controversial bit, I think, of the advice, because the debate is raging at the moment as to why you would walk away from the dollar, given I think, as David from HSBC put it, it's a bit of a cockroach-infested hotel, but it's still the best hotel on the block. And when you look out on the streets, they're strewn with garbage. So every time you think you're going to check out, you just have a look around at the alternatives and walk back in. Does that not keep the dollar strong, even as interest rates perhaps come down?
Well, I'm old and I'm old-fashioned. I think interest rate differentials explain a lot of the foreign exchange movement. And I think the U.S. has further to cut than what the ECB can do. And there's talk that the ECB might move 10 basis points. Now, I don't think the Fed will move 50 next month. They'll probably move 25 and then wait and see. But if there's any softening of the data, the Fed will be on an easing mode. So I think the U.S. dollar, what has driven it higher, it's been the interest rate pickup. That's going to slowly be reversed, because the fact is the Bank of Japan, the ECB, to a lesser degree the B of E, don't have the room to cut interest rates as much as the U.S.
So you talk about the limitations facing the ECB at the moment in terms of what they can do moving forward. Does that mean that they're really at the mercy of the global economy?
I think they played their last cards months ago. They don't really have much room. They really need a pickup in the global economy and trade their way out of benign, sluggish growth. Interest rates, sure, can go more negative, but what they're doing is bankrupting the savings sector, the pension funds, in Europe, by having negative interest rates. There has to come a time where policymakers think we need to make this right to protect our long-term savings institutions, because negative interest rates, just bankrupting them.
I don't know if that's going to happen anytime soon. I mean, yesterday we heard from De Guindos, the ECB member, suggesting that the impact of negative rates on the financial system has been neutral.
Well,
that sounds like
the response that I was expecting, I have to say.
Well, was it his Pinocchio moment? I know we were talking about that on the team. Was his nose getting longer even as he was saying that?
I don't think I would necessarily agree with that, but all I know is, I've got a euro account that pays me a negative interest rate. So if I don't do anything, my balance goes down. If I have a dollar account, simplistically, I get paid for my savings, and I think that is unsustainable over the long term, because capital flows will move out of the eurozone unless we see rates rise.
And just to be clear, one clarification, when you say the ECB already played their last card months ago, are you referring to the launch of, or the announcement of the TLTROs?
Well, it's just, well, A, interest rates are already negative, and B, they're running out of bonds to buy. Unless they increase their threshold of maximum holding, they're eventually going to have such a large percentage of debt on a country-by-country level. They're just physically running out of securities to purchase.
Well, I'm very much on your page about political influence on central banks and the low rate environment perpetuated very clearly. And therefore risk assets going up further, particularly equities. My question and my worry is the following. That means on the investment side, all these pensions, institutional investors and also private investors in this largely negative rate environment, there's a crazy search for yield going on. Has been for a long time already. And creating, of course, imbalances of structural sort, be in high yield debt, corporates, or I can look at construction development in Switzerland, property, because we have ultra low, we have negative rates. So where are you worried about the kind of backlash from this unsustainable demand and pushing for the little yield which is out there and which could create more imbalances in the capital market? I mean, that's a clear medium-term thing.
We're already back to 2008, 2009. We've seen a UK fund, Woodford, get into trouble because of liquidity mismatches. We've seen it with H2O, where they had a large debt position. And I think you're not getting paid in sectors of the high yield market to take on that level of yield. It's the risk premium is out of sync with history, but investors need more than zero. And what we're finding is people are going down the credit curve, out the yield curve, and that's a game that ends badly for everyone at a point in time.